Okay, in this video, we're going to talk about understanding gold's role in a commodity cycle. And you probably know that there's a pattern of sector rotation in the stock market. There's also a rotational pattern in commodity bull and bear markets. Typically in a commodity bull market, gold goes up first. Gold actually tends to be one of the first things to bottom in a commodity bear market, but it goes up first in a commodity bull market. And silver tends to lag gold when gold first begins a bull market, but then silver can go up at a faster rate than gold. Silver tends to be more volatile than gold, so it goes up more and down more than gold does. But at first, in a gold bull market, silver tends to lag. But as gold goes up into new bull market, then other commodities that are lagging, they actually then go into bull markets and follow gold to set the stage for an overall commodity bull market. A thing about it, though, is historically energy and oil also tend to be the very last commodities to begin bull markets of their own. Let's take a look at gold right now as I'm doing this video in April 2016. You can see that gold formed a stage 1 base from 1999. It jumped up in 2000, 2001, completed this entire basing phase, and began a bull market that went on for years, really ended in 2011 with big drops, of course, in 2008. But now gold has once again jumped up through the 200-day moving averages, through a stage 1 base. The outlook for gold now is very positive and very bullish. However, here is the CRB index. The CRB index holds a basket of commodities, and it's been declining substantially since 2014, and it has not gone up like gold has gone up. And interestingly enough, you can see it also lagged in 2009. It lagged in 2001 and 2002. Did not go up as fast as gold did. What the CRB index does, it tracks an entire basket of commodities, but it's also heavily weighted by the oil and energy complex. Well, let's take another look at gold and the CRB index so you can see this even more clearly. Here we have the CRB index in purple. Gold, of course, is in black. And you can see this divergence between the price of gold and the CRB index really began in 2014 when the CRB index really fell very hard. Oil prices dumped really bad during that time, but so did other agriculture commodities and meat commodities and commodities across the board. Gold did fall in 2014, but nothing like the rest of the commodity complex did. It began to diverge away. And you can see that in the gold divided by CRB ratio, the relative strength ratio, how it really shot up beginning in 2014 and has continued higher. You can also see that since the start of this chart, way back in 1998, that gold has led the CRB index. Gold has gone up much more than other commodities, much more than the price of oil, in fact. So gold has been really one of the top things to own, period. As we point out at the very beginning of this series, gold's gone up more than the stock market has for a very long time. So there you go. But I wanted you to see the overlay in these two charts here. Doesn't mean there isn't opportunities to buy the commodities, because as you can also see from watching this chart, looking at this chart, commodity, the CRB index, has had big runs, such as in 2010, such as in 2007, 2003, and so forth. So those swings can be very profitable. Now let's step back and look directly at oil and and gold. Once again, oil here is in purple, gold is in black. You can see how the prices of gold have diverged away from oil over the past 2 years. Oil is still, seems to be in a stage 4 decline, in fact. And if it's not, then it's just starting a stage 1 basing phase. So oil is lagging gold. Oil is likely to continue to lag gold because, recall, oil tends to be the very last commodity to go up in a commodity bull market cycle. Other commodities tend to go up first. Here's one, for example, corn, here in purple, gold in black below it. And you can see how corn tends to have these big spikes up and down. This is actually what most commodities do in the agriculture complex, spike up and down. But I want to point out to you something I've added on this chart. That's the correlation analysis, comparing how closely correlated the price action of corn is with gold. And you can see it's basically hovers around 0 over a 200-day moving average period. It's negative 0.10. That means there's really no clear correlation at all. And I think that sets up for a great opportunity, because what that means is we can buy gold, and we can also trade or buy wheat as it's totally as something not acting with gold, and wheat doesn't act in the stock market either, in its own trading world. And that means we can use something such as wheat to further diversify our investment accounts. Now, I don't own wheat, but as I do this video, in some of my accounts, I own DBA. DBA is an exchange-traded fund that owns a basket of agriculture commodities. There's another one, RGA, which is the Rogers Agriculture Fund too. But what I want to point out to you is the correlation of DBA with gold is also on the 0 line, not a real correlation. And for me, that enables me to have a position that's not really trading in sync with gold at all. And by owning gold and DBA in my model ETF rebalancing portfolio, which my own money closely mimics, I'm owning things that are not trading together. That provides further diversification for my overall portfolio. And that also creates a way to boost overall returns over the long run by being diversified in a mix of ETFs. I've usually used 5 ETFs, 20% in each one, and maintain that allocation by doing trades every single week. So if one ETF goes up above the 20% level, it can be sold, money moved into ones that are going down, and to keep the 20% allocation, periodic rebalancing. But what that does is provide a long-term portfolio boost in returns and smooth out the volatility and drawdowns for the entire portfolio. That's a concept that is, I think, a secret to money making that very few people know about. The next module is devoted to explaining how this works in detail, but I want you to see that when we think about commodities, two key concepts. There's a cycle to these things where gold goes up first. Other commodities eventually go into bull markets, but they don't really trade in sync with gold. That creates an opportunity to be invested in gold and then wait to see what these other things do, and a diversification bonus. So let's move on to the next video or the next module and take a closer look at the model portfolio rebalancing system.